Someone bought a share of a company this morning before finishing their coffee. They didn't call anyone, didn't sign a paper, didn't visit a building. It happened in milliseconds, across servers, through a system most people never think about. And that system is moving trillions of dollars every single day. Most people interact with the stock market through an app, a 401k, or the news. But very few actually understand what's happening underneath when a trade goes through. That gap matters, because the people who don't understand the system often pay for that confusion, not dramatically, quietly, in timing, in fees, in decisions made on bad assumptions. So let's start at the actual beginning, not with investing advice, but with the structure. A stock exchange is, at its core, a marketplace. Not a building, not a brand, not a number on a screen. A marketplace where buyers and sellers come together to trade ownership in companies. When a company wants to raise money, one option is to go public. That means they divide the company into millions of small pieces called shares. Those shares are then listed on an exchange and offered to the public. The company gets capital. Investors get a stake. The exchange provides the infrastructure for all of it. Now here's where most explanations stop being useful. People hear marketplace and imagine something like a farmer's market or an auction room. Someone holds up a stock, people shout prices, someone wins. That used to be roughly accurate decades ago on physical trading floors. Today it's almost entirely electronic, and the mechanism is completely different. When you place an order to buy a stock, you're not talking to a seller directly. You're submitting a request into something called an order book. The order book is a live, constantly updating list of buy orders and sell orders for every stock. On one side, every buyer states the price they're willing to pay. On the other side, every seller states the price they're willing to accept. When those two numbers match, a trade executes automatically. That matching happens in microseconds, millions of times per day, across thousands of stocks. The exchange itself doesn't own any of those stocks and doesn't set any of those prices. It provides the rules, the technology, and the infrastructure for matching to happen fairly. Think of it like a referee and a scoreboard combined, not a player. Now here's a misconception that trips up a lot of otherwise intelligent people. They assume the stock price is something the company controls, or announces, or updates. It isn't. The price you see on any given moment is simply the last price two parties agreed on. That's it. It's not a valuation, not a recommendation, not a signal from the company. It's the most recent transaction, nothing more, nothing less. If nobody has traded that stock in the last 5 minutes, the displayed price is 5 minutes old. That sounds minor until you're watching a thinly traded stock move on low volume. The exchange records the transaction. It does not verify whether the price makes sense. That's a different layer entirely, and we'll come back to it. For now, understand that price discovery, the way prices form and move, is a crowd phenomenon. Thousands of buyers and sellers, each with their own information and their own logic, creating a number together. That number can be rational, irrational, emotional, or somewhere in between. The exchange doesn't care, it just records what happened. Now let's talk about who actually has access to this system. You can't walk up to the New York Stock Exchange and start placing trades yourself. Individual investors access the market through brokers, firms that are officially registered members of the exchange. When you tap buy on a brokerage app, your order travels through several layers before it executes. Your broker receives it, routes it, sometimes to the exchange directly, sometimes elsewhere. That sometimes elsewhere is worth pausing on. A significant portion of retail trades, meaning everyday investor trades, never actually reach the main exchange floor. They get routed to what are called market makers, private firms that handle the other side of your trade. Market makers agree to always be ready to buy or sell a given stock at posted prices. They profit from the spread, the tiny gap between the price they buy at and the price they sell at. A fraction of a cent per share, multiplied across millions of trades, adds up fast. This isn't illegal, it's how liquidity gets maintained in the system. But it does mean the path your trade takes is more complicated than most apps suggest. The clean interface you see is built on top of a layered, messy, highly optimized infrastructure. That infrastructure is designed to be fast, not transparent. Here's something most casual investors never consider. Not all stock exchanges are the same, and there isn't just one. In the US alone, there are more than a dozen registered stock exchanges operating simultaneously. The same stock can be listed and traded on multiple venues at the same time. Sophisticated trading systems constantly scan these venues for the best available price. For most retail investors, this happens automatically in the background. But the fact that it exists tells you something important about how the system actually prioritizes speed and price efficiency. Exchanges also have trading hours, which is a constraint that feels obvious but has real consequences. Regular market hours in the US run roughly 9:30 in the morning to 4 in the afternoon Eastern Time. News doesn't wait for that window. A company can report earnings at 7 in the evening, and the price can swing dramatically before the market opens. Pre-market and after-hours trading exists, but liquidity is thin and spreads are wider, meaning the cost of trading outside regular hours is quietly higher for most people. A lot of investors have learned that lesson the hard way, placing an order after bad news drops, getting a fill at a price significantly worse than what they expected. Now here's the part of the exchange system that most people assume exists but actually doesn't work how they think: oversight and circuit breakers. There are mechanisms built into exchanges specifically designed to slow things down when prices move too fast. If a major index drops beyond a certain percentage in a single session, trading can be paused entirely. These are called circuit breakers, and they were introduced after markets crashed faster than humans could respond. The idea is to create a moment of friction when the system starts behaving erratically. Whether they work as intended is genuinely debated among people who study markets seriously. But they exist, and their existence tells you something honest about the system. The exchange is not a perfectly rational machine processing perfectly rational information. It's a system built by humans, patched over decades, layered with rules added after things went wrong. The technology is extraordinary. The underlying human behavior it's channeling is not always rational. That tension is permanent, and it shows up in every major market event people point to as an anomaly. They're not anomalies, they're the system working exactly as it was built, under pressure it wasn't fully designed for. One more layer worth understanding before we get to the practical side. When a company first lists on an exchange, that's called an IPO, an initial public offering. The company works with investment banks to set an initial price, then shares are sold to the public. After that first sale, the company itself no longer receives money when its stock trades hands. Secondary market trading, which is almost everything you see daily, is investors trading with each other. The company is watching, but not participating financially in those transactions. This surprises people. They assume buying a stock directly supports the company the way buying a product does. In a very indirect way, a higher stock price can help a company raise future capital or attract talent. But the direct flow of money in daily trading goes between investors, not to the business itself. So what does all of this actually mean for someone trying to make sense of their money? First, understand that the exchange is neutral infrastructure. It doesn't know your goals, your timeline, your risk tolerance, or your rent due date. It processes orders. That's the complete list of things it does for you personally. The meaning you assign to price movements is entirely your own construction. A stock dropping 10% in a day is just a series of matched orders at lower prices. It is not a verdict. It is not a signal. It is not a message directed at you. Whether that drop matters depends entirely on context the exchange has no access to. Your holding period, your cost basis, your need for that money, your alternative options. None of that lives in the order book. Second, speed is not the same as advantage for most people. The firms spending hundreds of millions on faster infrastructure are not competing with retail investors. They're competing with each other for fractions of a cent at volumes most individuals will never approach. Trying to trade fast as an individual investor is roughly like showing up to a Formula One race on a bicycle. The track is real, the race is real, but the competition is not actually between you and them. Third, liquidity is something most investors take for granted until they need it. In normal conditions, you can buy or sell most large stocks almost instantly at a fair price. In stressed conditions, that assumption breaks down faster than people expect. Bid-ask spreads widen, volume dries up. The price you see and the price you get diverge. This happens in corrections, in crashes, in sudden news events, in thinly traded smaller stocks. The exchange keeps functioning. The experience of trading inside it changes significantly. Here's the overlooked trade-off that almost nobody talks about clearly. Exchanges create liquidity, which is genuinely valuable, but that liquidity also enables impulsive decisions. The ability to sell anything instantly, anytime, during any emotional moment is not purely a feature. For a lot of people, it functions as a liability. Long-term investing requires patience. The exchange makes patience structurally difficult by design. Every price movement is visible. Every red number feels like a question you need to answer. The infrastructure was not built around your long-term goals. It was built around transaction volume. Those are different objectives. The practical response to understanding all of this isn't to avoid markets or distrust them entirely. It's to use them with a clearer sense of what they actually are. An exchange is a tool for price discovery and liquidity, not a wealth-building machine on its own. What you bring to it, your allocation, your timeline, your behavior during volatility determines most of your outcome. The exchange just executes whatever decision you've already made. And that's where most of the real work happens, before you ever open the app. One thing worth sitting with before you make any market-related decision. Do you actually understand what happens between the moment you tap buy and the moment a trade settles? Most people don't. And that's fine, until it isn't. Because the moment something goes wrong, an unexpected fill, a price that moved before your order hit, a stock that behaved nothing like you assumed, that's when the gap in understanding becomes expensive. Not understanding the exchange won't necessarily cost you money today, but it shapes every assumption you carry into the market. And assumptions are where most investing mistakes begin. The exchange doesn't grade you on understanding, it just processes your order either way.